Welcome to Learning Equinox. In our video last Friday, we discussed the basics of stock market for beginners. There, we talked about the difference between trading and investing and also discussed what are the few key points that you need to keep in mind before investing in stocks. If you've not yet watched that video, I shall leave it here in the iCard for you to watch it. Today, we shall touch upon trading in stock markets. For ease of understanding, we have divided this video into three parts. Firstly, we shall understand what is trading. Next, we shall discuss the different types of trading. And lastly, we will understand how to earn money from trading. So let's begin. Do watch this video right till the end to understand the entire process of trading in detail. Firstly, let us understand what is trading. It is simply called buying and selling. Here you do not look at long-term returns but work on short-term. You only look at prices of the stock market and decide your buying and selling patterns. A trader buys stocks and sells it over a short period of time and thereby makes profit from it. This is called trading. Second part, what are the different types of trading? So, there are 4 different types of trading. First one is called as scalping. Here, you buy a stock and sell it in a few minutes of the price change. It's important here to monitor the stock price and jump in when the price falls and sell when it rises. The next one is intraday trading. In intraday trading, you trade for a few hours. This means you close your deal by the close of the day. So you buy and sell and then you need to square off your deal on the close of the stock market. Here, you can also do short selling, which means you sell first and buy later. So when you see price is going to fall, you book a sale deal and before close of the day, you square off your position by buying that deal. The third one is swing trading. In this type, you hold the stock for a few days. So let's say you buy it today and hold it for a few days and you sell it at the end of maybe a few days or 1 or 2 weeks. And the fourth type is called as position trading. In this method, you buy the stock, hold it for a few weeks or a month, and then you sell it when the price of the stock rises. So maybe, you wait for a dividend to come in and you sell it post-dividend and things like that. So that is position trading. Lastly, how to earn from trading. How do you actually make money from trading? Firstly, you need to understand that you are trading for a short term. So the benefit you will get is only if you trade in larger volumes, which means you earn more if you play in larger volumes, which means you need money for it. So even if there is a margin offered by the brokers on stocks, still it is a multiple. So you need to put in a larger volume to make larger profits. The next one is understanding PE ratio. PE ratio is price earning ratio. Now, this is a very significant tool, be it an investor or a trader. Understanding PE is one such tool which can help you understand the stock market movement. PE ratio formula is share price divided by earning per share. This means what price you should put in your money and to get what return. So, this helps in understanding company valuations. Now, all companies have their PE ratio. This is also available for Nifty 50. Nifty 50 is nothing but a representative of the top 50 companies. So, this is an indicator of the performance of these top 50 companies, which means whatever is the PE ratio of maybe the Nifty or the Bank Nifty is nothing but the representative of all the top 50 banks and so on. So, you have the Nifty 50, you have the Bank Nifty, all of these PE ratios are indicators whether the movement is up or down in the market. Which means that with the help of Nifty 50 PE, you can understand the trend of stocks. This can also be considered as a benchmark indicator for analysis. Now, the common trend in the past few years, it has seen a lowest PE as around 10 and highest PE as around 30. So, if Nifty PE is 10 or around that, you can invest. So, market is cheap in that case. If it's nearly between 25 to 30 means market is expensive, you need to divest. This can help you gauge the stock market volatility easily. PE is a concept you can use for investing as well as for trading purpose. As a trader, you will know that if the PE is down, then you need to buy and sell when the PE is high. For trading, the third point is important that you need to learn technical analysis. Technical analysis is a study of price movement through graphs and charts. How volumes affect price changes and what determines price movement is an important part of technical analysis. We shall be talking about technical analysis and fundamental analysis in our coming videos, so stay tuned to Learning Equinox by subscribing to our channel. The fourth point is understanding stop loss. You need to understand stop loss to minimize losses. How you are going to use stop loss features. In order to do trading, it is important to understand the concept of stop loss and how you will be making effective use of stop loss to minimize your losses. This again is a concept used by traders for trading short. The fifth one is ongoing learning. The last and the most important step, I would say, is to keep learning and keep equipping yourself with latest happenings in the stock market. Understand the different concepts and analyze trends on an ongoing basis to sharpen your knowledge about the different developments in the stock market and technical analysis. At Learning Equinox, we are coming up with short courses on stock market where we shall study the different concepts like fundamental analysis, technical analysis, derivative trading. When I say derivative, it's about futures and options, what they are, how to trade with them, and so on. So stay tuned by subscribing to our channel and register for any of these by clicking on the link given below in the description box. Thanks for watching. Stay tuned for more.